Thursday, January 20th, 2022, Monaco 64, home of alternative economics and contrarian views. Today we're going to look at how central bankers are powerless to stop their own inflation that they've baked into the cake. What we're getting now is not inflation. We're getting the consequence of inflation. And what is that? Well, it's the debasement of the currencies. And when currencies get debased, they buy a lot less. Then that's reflected in higher prices. I keep seeing stories in the mainstream, and that's not surprising, of course, because they've corrupted the definition of inflation. For example, in the UK, we had the CPI and RPI data yesterday, and I like to focus on RPI because that was the price data that was used before new labor came into power. That one came out at 7.5%. It was expected to come out at 7.1. The CPI, which is usually a percent lower than the RPI, and you can see why the bankers, central bankers, politicians use that one. Well, that one jumped from 5.1 to 5.4. It was expected 5.2. So, yes, these rising prices, these CPI numbers, they're not inflation. They're the consequence of inflation. Yes, as I said, there are stories saying that food prices drive inflation. They've got it the other way around. It's inflation. And why have they corrupted that? Well, because if they tell the public the truth, not that the public needs anymore to get really angry, they will realize that the people behind the inflation, of course, are governments and the central banks, the monetary system. They create the inflation. And how do they do that? Well, governments have borrowed 15%, 12% of the economy in the last 2 years, respectively. And how do they do that? Well, the Bank of England and other central banks, they buy the bonds for the government. They keep it at a rate that is ridiculous, that is actually costing investors in real terms. It's called financial repression. So that's what we're getting. But the system is so leveraged, not just the financial markets, but the whole economy, the credit-induced housing, financialized economy in the UK and everywhere else, that the central bankers can only pretend that they're going to fight the inflation that they create. And what do I mean by pretend? Well, they can only raise rates so much. If they really wanted to put a halt to this inflation, they would need to raise rates to double digits in the UK and in the US, I would say. A bit like Turkey has had to do, even though they've cut rates. So what's going to give? Well, I think gold and silver in the last few days, they've woken up. And it's been frustrating, and it's still early days, but I think they're pointing to the fact that investors are realizing this, the majority of people. There's the old saying, I think it was Abraham Lincoln, you can fool most people most of the time, but you can't fool everyone all the time. And I think this is coming home to roost, and it's going to be reflected in a lot higher prices of gold and silver, of other commodities that have already been rising quite sharply. It's going to be reflected, I think, in government bond markets. Yes, they're still somewhat under control, and I would say that it will probably be reflected in a bond market like the UK government bond market. We still have rates there below 1.3% for 10-year money, which is ridiculous, seeing that the RPI is at 7.5%. Back in the 90s when I started out, late 80s, early 90s, if RPI was at 7.5%, you can bet the 10-year gilt yield would be at just under 10%, maybe at 10%. That's where it should be. Can you imagine mortgage rates being at 12, 13%? And they have been before. People, we had that in the early 90s here. But right now we can't because everything is so leveraged. There's so much debt, especially government debt. So yeah, I think these are very dangerous times in terms of finance, in terms of the markets, and even precious metals and the miners. As I said yesterday when I spoke about silver, hold on to it because it's going to be very volatile. But we're going to look at gold and silver now and the markets. Yesterday, looks like gold caught up with silver. Silver had done really well, as I said the day before. I think it was Tuesday. Yeah, yesterday was Wednesday. And yesterday, I wasn't following the market very closely. I went out. And then someone that I was with said, oh, look, gold is at 1838. And I said, wow, it's broken out because 1830 was the key level. So it looks encouraging in terms of the longer term. Short term, a lot can happen. So yeah, we're going to look at some charts today of gold and silver, and we're going to look at the markets. So let's start looking at the markets, and then we'll look at the charts here. It's 8:37 a.m. London time. We've got spot gold down about $0.50, just below 1840. So the high's been 1844 and the low 1837.79. Yesterday the low was 1810 overnight. So it had a huge range. Gold was up quite significantly. And a chart that I like to look at is the monthly chart, because it shows you gold back in 2011, 2012. 2011, of course, we touched 1920 or thereabouts. And then we came off. And then in the next year or so, gold tried to come back above 1800. And it failed there like 3 times. And I think this is what was happening here. The powers that be, or the market forces, we're trying to test this 1800. That's why I think it's been such a battle and it's taken so long. But if you look at this triangle I've drawn, or pennant if you want to call it, from the all-time high in August 2020, yes, we've broken out of that triangle. Some people are looking at other triangles in a daily or weekly chart, and they have higher levels. But I actually think if you look back in November, we tried to break out of that triangle, and that was rejected. And now it looks like 1800 is a really key support. We might still go down there and test it, but I think it will be very good support. And on the upside, there isn't really that much resistance, maybe except the high from November last year, which was around 1875. So we need to keep that level in mind. So I think it's looking pretty good. It looks like 1800 now is the base. And things could move quite quickly, especially if investors realize that the central bankers basically have no clothes. They can't really stop the inflation. And we've seen the stock markets as well being under pressure, especially in the US. I mean, I think the NASDAQ, for example, that's already down, let's see, year to date. It's down 8.34%. We've got the small cap Russell down about 8. So that's something that the central bankers need to consider. And the bond markets, we got up to 1.9 yesterday in the 10-year. That's going to hurt corporate bonds, mortgage rates, everything. So it's a big mess, I think. And So silver as well continued to do well yesterday. This morning we're up about a cent at 24.15. We've been up to 24.27, and as you can see in this weekly chart, I think 24.50 is the next resistance. Another triangle here on the weekly chart of silver. Of course, I spoke about the big teacup, 42-year teacup formation. I think that's significant as well. So all very interesting. And as I said, yeah, commodities and the precious metals are pointing to a lot more inflationary pressures, which will be basically impossible for the central bankers to stop unless they want to collapse everything. And yeah, that will lead to bankruptcies, huge bankruptcies everywhere, governments, corporate, individual consumer bankruptcies. And I don't think they want that. Politicians always want inflation, and so do the bankers. So we're in interesting times. That's all I can say. So now back to the markets. I saw the markets had a tough time yesterday as well. NASDAQ and the Dow. Right now, though, the Dow is up 120, the futures. The NASDAQ is up 57, and the S&P is up about 14. FTSE is up about 5 points. To the currencies, sterling is up about 1/8%, 136.30. The euro is up 1/8 as well, 113.57. And the dollar is unchanged versus the yen, 114.36. The dollars continue to drift lower versus the yuan. It doesn't look very good versus the yuan. Right now it's at 634.73. Aussie dollar, that's up 1/3 at 72.35. The dollar is down 0.2 versus the Canadian dollar, 124.92, and the Kiwi dollar is down about 1/10 at 67.76. To the commodities, WTI crude is down 1/3. Overnight high is 86.04. Right now we're at 85.33. High grade copper up 0.75%, just above 450, and then we'll quickly look at the 10-year yield, see what it's doing this morning. It's up 2.2 basis points at 185. And you've noticed as well now that even with yields going up this beginning of this year from around 1.5 at the beginning of the year to 1.9, we're seeing gold and silver actually go up. And that's very significant because a lot of people think that gold and silver won't do well with higher yields, but that's not what happened in the 70s when the Fed was chasing inflation, like Rafi Faber of the Endgame Investor says. From 1977 to 1980, the Fed let rates rise, but it was chasing inflation. It was never enough. It was only when Volcker really let rip, let rates go to like 20% in 1980, 81, that they were able to really slow down the inflation because they didn't stop inflation. What you had was disinflation, which is still inflation, but at lower rates. And it's still currency debasement, but they were able to save things. But they can't do that in this day and age where the national debt is like 130% of GDP. Back then it was around 35% of GDP. And household and consumer and corporate debt were a lot lower. So if you enjoyed this video, make sure you hit the like button. Think about subscribing to my channel. If you haven't yet, make sure you share this video far and wide. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.